IFRS, International Financial Reporting Standards, and US GAAP, Generally Accepted Accounting Principles, are two different accounting systems used by companies to prepare financial reports. Both have their own rules and purposes, depending on where and how they are applied. IFRS is based on principles. This means it gives companies guidelines and flexibility to decide the best way to report their finances, depending on their situation. On the other hand, US GAAP is based on rules. It provides very detailed instructions for specific situations, which makes it consistent but less flexible. In IFRS, assets are often measured at fair value, meaning their current market price. This helps show the real value of assets. In US GAAP, assets are usually measured at their historical cost, meaning the price paid when they were bought. IFRS focuses on contracts with customers. Companies record revenue when they deliver goods or services, not when they receive payment. US GAAP also recognizes revenue based on delivery but uses more specific rules for different industries. IFRS requires companies to show comprehensive income, which includes items like currency differences or unrealized gains. In US GAAP, this is optional. IFRS requires most leases to appear on the balance sheet as assets and liabilities. This applies to nearly all lease agreements. US GAAP classifies leases into two types, operating and finance leases, and treats them differently. For impairments, loss of asset value, IFRS allows companies to restore the value if it recovers, but US GAAP does not. IFRS is designed for companies operating globally. It helps investors compare businesses across countries. US GAAP is mainly for companies in the US, ensuring consistency for American investors. Both systems are good for their purposes, and the choice depends on the company's market and audience. IFRS offers flexibility for global use, while US GAAP provides strict rules for the US market. Companies use the one that best suits their needs. Useful expressions. Our company follows IFRS, so we need to ensure all financial reports comply with international standards. Understanding the differences between IFRS and US GAAP is important for our global operations. The flexibility of IFRS allows us to adapt our reporting to different markets. US GAAP provides detailed rules, which make it easier to apply in specific situations. Under IFRS, we need to evaluate this asset at its fair value, reflecting the current market price. US GAAP requires us to record the asset at its historical cost, which was the purchase price. For this contract, we need to recognize revenue when the performance obligation is satisfied, as IFRS requires. US GAAP treats operating leases differently from finance leases, so we need to classify this correctly. Under IFRS, if the asset's value recovers, we can adjust the impairment loss in future reports. Since the report will be shared globally, we should use IFRS to ensure consistency.